regulated free markets, and to more or less J.P. Morgan, who was in charge of this, James Pierpont Morgan. The House of Morgan was the lender of last resort and fought against the Federal Reserve because they didn't want to lose that to a federal regulator. So before we had a regulator, we had different states printing their own money, which was often worthless. You didn't know if your money would be accepted across state lines. People had to carry medals because so much of the money was false, right? So if you actually take out a dollar bill in your pocket, or any denomination, 1, 5, 10, 50, whatever, 20, 100, right? You'll see it's Federal Reserve. No, the Federal Reserve standardized this. So while the Federal Reserve certainly leaves something to be desired, the absence of the Federal Reserve, a little bit like the absence of the mortgage market, makes sense as an angry response to a feeling of betrayal and misadventure and some real asleep at the wheel time by a regulator. All well understood. However, this abolished the Federal Reserve. I call it the Ron Paul story, right? And having worked with some people who are the money guys for Ron Paul and met and talked to them, smart, interesting guys from the Von Mises Institute, I'm not sure that's the solution that you should be most comfortable with. So what the Federal Reserve is doing here is overseeing fractional reserve banking. What fractional reserve banking is, the Federal Reserve sets a limit on how much of every deposit you can lend out, right? So it's approximately 10% now. So if I come in and deposit, I move to Rhinebeck tomorrow and I deposit a check, $1,000, right? The bank has a right to loan out $900 of that. They give me the credit for $1,000, then they go to you and they loan you $900, contingent on you opening an account there, which all the banks require. You then open up an account, you deposit the $900. They then take $810 of that and loan it to him. So the same money is being churned lots of times, called fractional reserve banking. All modern banks are faith-based initiatives.
So it's like a Ponzi scheme.
Faith-based initiative.
But it's not a Ponzi scheme, it's not illegal, right? Charles Ponzi sold stamps that didn't actually have the backing to return the letters from Italy, right? In fairness to Charles Ponzi, he had a decent idea, he got, but he began selling products he didn't actually own, right? What this is an attempt to have less money facilitate more transactions in the economy, right?
If you keep adding up the amount of money that's lent out on the initial
it's a geometric
$1,000,
approximation.
you end to get
the initial.
you get that there's a debt of $10,000 for every $1,000.
So that would be a liability.
A liability.
Yeah, the way bank balance sheet would work, you'd have a $10,000 total liability, a $10,000 total asset. They'd cross at a zero net, right? But if I did the $1,000 with standard rules, and the bank chose to lend the money out, the bank can choose at any time to say no. The public can choose at any time to be unwilling to borrow. Businesses can be unwilling to borrow. But if everything is called fully lent out, zero excess reserves in the system, my $1,000 deposit at the Rhinebeck, I don't know the names of the banks, whatever, Rhinebeck Savings and Trust will produce $10,000 expansion in the money supply here. In the greater Rhinebeck metro area, Rhinebeck SMAs, just metropolitan area. I don't know how you define it.
It's a pyramid scheme, basically.
It's not necessarily a pyramid scheme. As long as people keep the faith, it goes on. I think the faith-based initiative, I don't want to give anyone a hard time or offend anyone's beliefs. I think the faith-based initiative thing works. It's a little bit like God. And I'm not a religious person, and I don't want to offend anyone, but God's there so long as you believe God's there. If you need to meet him in the hallway, it might be tough.
The pyramid scheme is a faith-based initiative. As long as people believe that it's going to keep on coming in the future, it keeps going. And then at a certain point, there's a panic, and that's the end. Which seems like it's the same thing here. As long as people believe that this debt is going to be recovered.
If everyone pulls their money out at once. There are safeguards, right? So you have to keep 10% of all the deposit value in what's called vault cash or access account at the Federal Reserve. So if you have a $100 million book of business, we know that you have to have $1 million in there at all times in cash, right? They also have limits on your accounts on how much you can pull out at one time or one day. Some of you may have encountered this. You go someplace and you try to take out more than $500 or whatever your limit is, right? And it tells you, nope, you exceeded your limit.
At the point where everybody feels
they'll trigger it. If you look,
going to be able to pay this back.
Right.
That seems to be what's happening.
We could have a run on the bank. There was real fear at Bank of America that there would be a run on the bank in 2008 and again once in 2009. If you look closely at your banking contract that you sign with them, they have the right to randomly deny you access to your money for 136 hours by declaring the initial processing need. They also have a standby loan from the Federal Reserve. They also have standby loans from other banks. And they can borrow limitlessly from the Federal Reserve you know, in an emergency situation.
You're getting that now though, right? From the discount
Those are a
window?
different, the discount window is slightly different. This is the Fed funds and overnight window, but yes, there are multiple lending facilities. They don't pay nothing, but they pay very low, 1/4 of 1% right now for prime borrowers with access to the discount window.
Yeah, I mean, and you're talking about, what, $5 trillion that went out through the discount window? Is that the number?
Well, the discount window is revolving, so you get very different numbers if you add up the sum total of every visit. Average duration of a loan there is 270 days. They turn over pretty quickly. It's about half a year, not even half a year, 3/4 of a year. So they're short. It depends if you add them all up or if you take what's outstanding at any given time, right?
Yeah.
But lots of access was given.
But that's what's propping the banks up now, right? Not the TARP program.
I think we should have
A bunch of
actually people keeping track of who wants to talk.
Sorry.
Yeah, sorry.
Because people are just breaking in and it's just going to be a pandemonium. So I think somebody, I don't want to do it, but somebody should keep track of who wants to talk
got staff?
actually.
Megan, you do,
You mind doing that? I think it would go better than,
It's more organized. It's a good
you know,
system.
it's more organized. I'll raise my hand though because I want to talk for a while.
Well, I guess it's up to her.
Yeah. All right. And my question is really very short. I think you did a great job explaining the failure of wages to meet the expectations of middle-class society and the ramifications of that and how it tries to get covered up with the collusion of people who would be in the middle class or think that they are in the middle class. But in your presentation, nowhere, and I wonder if you purposely leave this out or it's just beyond economics, is the role of elected government in ensuring beneficial outcomes to the majority of the citizens in the country. You act in a way like there is no federal government here, that the banks, the speculators, the borrowers, we've all been involved in something that's a massive, pretty much a massive fraud is one way to look at it. It's illegal in many ways, and in many more ways than we're willing to admit. But you've totally left out the role of what we think, maybe naively, is the role of our government in making sure that there are outcomes that aren't so completely destructive to the nation and to the aspirations of the people.
It's a good point. I think there is a large government role. None of this would be possible without the government, right? So you have massive subsidy, you have control, they make the rules of the game to some extent, the government. I think in this area, that may be changing, but in this area you more or less get the government you buy. Or you have 65 people in the government spend 2 years coming up with a regulation that 600 people with 4 times the salary are already at work at subverting before the ink is dry. So you have a cat and mouse game here, and the government is not the cat, right? I think the presumption is the government would be the cat, right? Now, we could have situations, there are situations where, look, if you're a small business or startup or a small player in this field, you're very scared of the government and you're trying to comply with all kinds of regulations that are expensive. That's most of the firms. If you're a big, powerful, deep-pocketed firm, you're not so much, generally, in that situation. That being said, the financial firms have lost their position of dominance. The last 3 years, they're hated, they're massively less profitable, they fired a lot of their employees, and there's very little chance of them going back to their former glory. Part of the reason I don't like to heap the derision on the financial industry, other than I work in it, which is, to be honest, that's probably part of it, but the other reason is because everybody does. And it's kind of the lazy man's blame game here. If everybody had gotten, so I'm trying to tell you a piece of story that's not more essential than the pieces I'm not telling you. That's partially time and convenience, but there are other issues too. That is, I think we have had a discussion, since we've had one in the US, with a sort of traditional liberal and progressive screaming, it's the banks, it's the banks, it's the banks, they're evil. And the right wing saying, it's the government, it's the government, it's the government, it's the government. And what I'm trying to tell you is it's Main Street, it's Main Street, it's Main Street. It's everyone who didn't get a raise for 35 years. It's not 5 shady guys who went to graduate school too long in Lower Manhattan or Park Avenue in the 50s. It's not 6 bad regulators. It's not some Fair Housing Act, which was some vast conspiracy to give poor degenerates houses they don't deserve, right? These are the kind of the tomes that we're used to, right? What I'm saying, it's a basic way the economy functioned and coped with a mismatch between middle class jobs and middle class earnings, right? So the way I would message this in some places, I'm looking for short, quick, simple. And it's not short, it's not quick, it's not simple. So point is well taken. But for too many people every month, there's too much month left at the end of the money. And in all kinds of ways, they speculate or they borrow the difference. And for rich people, that might be hedge funds, and for poor people, that might be scratch tickets, right? And for some people, it might be payday loans, and for other people, it might be leveraged borrowing against a vacation home. But the story has a certain amount that's parallel, even though the circumstance, the effectivities, the rate of return, they can be very different. But it's a good point well taken about a very low, I give a low footprint in that flyover for federal, state, and local regulations. Kind of problem that America did, right? A problem that Ireland had to some extent too, and that the Swiss almost had, which was the biggest problem in a leveraged financial system isn't too big to bail, too big to fail, right? That's what everyone talks about. It's too big to bail. It's what happens if your financial sector is actually larger than the rest of your economy. Then when it blows up, you can't bail it out. Like you literally can't bail it out. That's a little bit what's afflicting the Spanish right now. It's been devastating in Ireland, right? And it was absolutely devastating to Iceland. So Iceland doesn't have a big enough government or economy to actually bail out its financial sector. It outgrew the rest of society, so they couldn't bail it out. So they got an austerity package. They were pressed to vote through to honor the debts, and they basically threw out the prime minister, indicted the former prime minister, and repudiated their debts. They refused to honor a lot of their debts. They went through a restructuring period, and they had a heavy amount of debt forgiveness, right? The thing is that Icelandic banks outgrew Iceland a little bit, blew up and devastated the entire economy. US global banks, the big banks, what we in the industry sometimes call the T-plus institutions. T-plus means more than $1 trillion in assets under management. They're global institutions, so there would be global ramifications. And they are not in terribly bad shape. And remember, there's a funny thing. American society runs on debt, which makes Americans much more vulnerable and dependent on their financial industry than people who are less debt dependent, right? And as we're talking about who's debt dependent, it's important to remember hostility to lenders tends to happen and be very successful in a very particular historic moment for 300 years, and that's when the government itself is broke. Our government